Hey there. I'm looking forward to talking to you about Money Wise with Keri Wise, a new series we're starting. I'm Keri Wise, Head of Retail Sales at United Community Bank. Today we'll be covering 3 important areas. First of all, budgeting, a really key component in financial wellness. Secondly, I want to talk about credit and tips for how to manage credit effectively. And third, I want us to talk about future and really planning for the future. When I think about financial wellness, I compare that to physical wellness. We always want to take care of ourselves physically, and financially is just as important. 70% of Americans can't get their hands on $500. That clearly is a sign of financial stress, and with stress comes a lot of unfortunate situations. And so we want to help you with your finances. So first, I want to talk about budgeting. And so the first tip of budgeting is knowing what's coming in and what is going out. That is the most important thing. And listen, budgeting is not always fun. I totally understand. When I was a young girl, my mom and dad would sit me down and we would do budgets for our upcoming vacation. Me and my brother rolled our eyes every time. But what it taught us was there's a budget and we need to plan accordingly for that so that our financial situation doesn't get out of hand. And so a couple of important tips as you're sitting down and doing your budget. First, look at what's going out of your account. I recommend looking at your last 2 months, either bank statements or if you use mobile banking like I do. And so the first thing is to really detail what's going out. Mandatory bills such as electricity, your house or rent payment, and eating, your insurance. What are the necessity payments that must come out every month? What are you spending in entertainment? And listen, I'm a big proponent of having fun as well. So we want to allocate money in the budget for fun activities. As you add those up, see where your total is, and then look at the next important thing, what's coming in. Am I positive or am I negative? If you do have a deficiency there, spend a lot of time looking at what can I reduce. Have you taken the time to shop your cable bills, your insurance bills? Have you taken time to shop your telephone service? Just one other quick example, Josh and I looked at our telephone company bills about 3 years ago, and we saved $50 a month changing cell phone companies. $50 a month, that's $600 a year. That's real money, again, at the bottom line. So how often have you shopped that? I recommend shopping it every maybe year to 2 years or so. Secondly, I want you to look at auto drafts. What is coming out every single month? And is it something you are still participating in? Maybe you're paying for something every single month that you used to do, but you haven't done in 6 months. Maybe it's time to cancel that subscription and save yourself $20, $30, $40 a month. Before you know it, that's $500 a year that you could put in long-term savings. For example, let me be honest, I was paying a gym membership every single month, and I wasn't going every single month. So I decided to cancel that membership. It just was not something I was using. Gym memberships are good, but if you're not using them, again, any drafts that are coming out of your account that you're not taking fully advantage of, look at, do you need to continue paying? It can really add up at the end of the year. Get yourself to a place where you can be break even, and then the very next month, look at where you can get to a savings piece. Next, I look forward to talking to you about credit tips. Credit is very important, and starting off with good credit and maintaining that good credit is very important. First, I encourage you to pull your credit. There are several companies that you can pull your credit for them annually. It's really important to see how is my credit. Second, we're going to look at 2 important things. One is revolving credit, and the next is unsecured credit. And there are 2 different buckets within your credit file. One, we're going to start with revolving credit. Credit card debt is really important to manage effectively. First of all, let me give you an example. A $10,000 credit card maxed out at an average rate of 18%. If you make the minimum payment 2%, $200, you will be paying on that credit card for almost 9 years. You will have paid an approximate $9,000 of interest over those 9 years for that credit. So before you make the credit card purchases, ask yourself, do I want to pay this bill for the next 9 years? So credit cards are not something that I like credit cards, to be honest. They're not something I think are bad tools. However, you've got to be real disciplined with them. It's real quick in today's society to pull out your purse or wallet and swipe that card and go. And next thing you know, you get the bill and oh my goodness, what have I gotten myself into? The other thing that's important with credit is how you utilize credit. So a big piece of your credit is timely payments. That will hurt you the worst. If you miss a payment, that will decline your score at least 40 points on average. That's the number one biggest hit. The number two biggest reduction in points are utilization points. That's what I call it. So if you have that same $10,000 credit card, I ask you to keep about $2,000 or less on that card. That's 20% utilization, and that is very, very helpful. So if you have a $1,000 card or a $500 card, you need to keep $200, $100 on those cards. One thing I do recommend on a low dollar card is online shopping. That's more from a fraud situation, to be honest. I want to help you minimize fraud. And so have a very low dollar online shopping card. Maybe it's $500 or $1,000, and you make those purchases for the companies through online shopping there. That minimizes fraud, and hopefully you can keep a low balance on those cards as well. It's really important that you keep a low balance because it's a low limit. So if you use that $1,000 card for $500, just make sure you're very intentional about paying that off very timely so it doesn't negatively impact your credit. So utilization matters. Next, home equity lines of credit, which is when you use equity in your home to make purchases or be there as a safety net should something come up. A fantastic tool to use if you own your own home and have equity in it. However, it does show on your credit report as a revolving credit line item, which is great, but again, you need to remember utilization. So if you have a $25,000 home equity line of credit that you're using, try to keep that balance approximately $5,000 to $10,000 or so. If you see that you're going to use almost all of that for a very long period of time, I would ask that you look at other fixed options, which I'll talk about in a few minutes. Again, that's to keep the utilization low on that piece. So the first part of your credit is payment timeliness and the revolving credit. The next piece is installment loans, which would be like a car loan. You get a car loan, you get a fixed payment at a fixed rate. So that would be your mortgage, your auto payment, and maybe when I talk about that equity line, I need $25,000 to remodel my bathroom, and I'm not going to be able to pay that off for 10 years. There's a closed-end option for you with that, and I encourage you to talk to your banker about those options. That might be the better way to go. It keeps your utilization low, and it keeps you an installment loan with a lower rate and a fixed payment for X number of years that suits your budget. So those are really important credit tips I ask that you consider. Lastly is the future. As you know, time flies. Half of 2020 is over, and for many of us, that's a good thing. But time does fly. And so as you look into the future, where do you want to be in a year from a savings perspective? Maybe I've never thought of savings. Maybe you're in that boat. Then I encourage you to look for $10 a week. And in a year, you'll have over $500 saved. Maybe you've started a short-term savings plan, but your goal is to be at $2,000 this time next year. Then look at what that means within your budget so that you can accomplish that. It takes discipline and it's not fun, but you can absolutely do it if you have a goal and a plan to get there. Lastly, long-term savings. That is so important. We will get older, and we want to live a life that we will enjoy when we get older. We've worked hard. And so what does that look like? One thing I recommend is if your employer is offering a 401k, take advantage of that. So many Americans fail to do so. And next thing you know, you're 30, 40, 50, 60. It's time, and I don't have anything. So I encourage you to think through that and participate in the 401k. If your company doesn't offer a 401k, then sit down with an advisor and take a look at what can I do myself starting now to contribute in a lot of tools. There are a lot of tools that you can contribute without a 401k, but you must sit down with somebody and get on the right path for long-term savings. Financial freedom is so rewarding and refreshing, and it's a little bit of stress we can help take off your plate. I encourage you to first sit down and do a budget. Remember the credit tips I mentioned. And lastly, think about your future. We want it to be rewarding. I look forward to spending more time with you on Money Wise with Keri Wise. Thank you and have a wonderful day.